7th of October 2019. That was the day OYO Hotels and Homes became only the second Indian startup to reach a valuation of $10 billion. It was a momentous occasion for the then 25-year-old Ritesh Agarwal, who was now the talk of the town. So OYO continued to expand, and by January of 2020, it had more than 43,000 properties with over a million rooms in 80 countries. Then came COVID. And by early 2020, OYO's occupancy had dwindled down to almost zero, employees were laid off, and many of their properties closed down. 2021 was even worse, with the company having to borrow millions of dollars just to survive. There were allegations of fraud, anti-competitive practices, the losses continued to mount, funding had completely dried up, legal suits were filed against the company and Ritesh. Everything was a and by 2023, SoftBank, OYO's largest investor, had cut its internal valuation from $10 billion to just $2.7 billion. No one was sure if OYO would survive this, but like a phoenix rising from its ashes, OYO did make a comeback in 2024, and things are looking a lot better now in terms of profits, growth, occupancy, focus, customer service, and its financial health. I'll say OYO's journey was more like a yo-yo, the toy that goes up and down. And I think this is a story worth telling as we track back to what went wrong in the first place. How did OYO manage its recovery? Where is the company placed now? As in what's driving its success, OYO's future plans, etc. As I look at all of this from the perspective that if OYO comes up with an IPO sometime in 2025, how should we as investors look at it in terms of its prospects and valuations? I've tried to make this video part business case study, partly investment thesis kind of a thing. But yes, it was fun putting it together, and I sincerely hope you like it. Let's begin. Okay, let's take it back to the beginning, and it was in the year 2012 when a 19-year-old Ritesh Agarwal had this idea of building a listing platform for budget hotels, and he named his website Oravel Stays. Like many Indian startups of that time, Ritesh took inspiration for his venture from Airbnb, a US-based home-sharing startup that was disrupting short-term rentals worldwide. However, it was another American who had a bigger impact. This guy, Peter Thiel, who inducted Ritesh into the Thiel Fellowship, gave him the tools, the knowledge on how to build and grow a business, and also got him started with a $100,000 seed funding. As things progressed, one of Ritesh's key insight was that for many Indians, finding and booking a budget hotel was not the real challenge, but it was the quality of stay. And so Ritesh's thought process was very simple. How can I use technology to standardize the hotel experience for a guest in terms of a smooth booking process, clean sheets, the air conditioning, hot water, Wi-Fi, toiletries, etc. And if I can do that for not one, not two, not three, but say thousands of hotels across the country, then there's probably a big business to be built here. And this is how OYO was born. Ritesh deployed his seed funding to hire a team, and his first client was a Mr. Rajesh Yadav at South City 1 Gurugram, to whom he famously said, "If the property loses money, I will take the brunt, but if it makes money, then we'll split it up." And boy, did he make money. OYO started by taking in a few rooms at a time, charging a commission of 15 to 25%. But after seeing the results, and because the company was also doing marketing for these hotels, more and more owners wanted their rooms to be run by OYO. As a result, and by 2016, this 3-year startup held an inventory of 65,000 rooms in some 6,000 odd properties in 100 plus cities, which also is when Masayoshi Yasumoto of SoftBank came knocking with a $100 million funding. I'll say after Peter Thiel, Masayoshi-san was the person who really believed in Ritesh, and SoftBank would continue to participate in further funding rounds, now owning close to 45% of the company. But Masayoshi-san's impact went beyond just funding as he pushed Ritesh to think bigger and take a more strategic approach to growing the business. For instance, OYO started looking beyond India and started operations and acquiring properties all around the world, including China and the US. The company hired thousands of people, especially in sales. And to get more hotels on board, OYO started a minimum income guarantee program, which as a model has its plus and minuses. The aggression worked, and in terms of total rooms, OYO became the third largest hotel chain in the world, with its total revenue increasing from 32 crores in FY16 to a little over 13,000 crores in FY20, which was a 400x jump in just 4 years. But as it often happens, with scale comes problems, and as OYO continued to grow, it experimented, it tweaked, modified, pivoted to the extent that things became a lot more complex and difficult to manage. Take the business model for instance. So in its initial years, OYO was just an aggregator in the sense that hotels continued to have good control over their operations and they looked at OYO positively as a partner in their progress. But then a few years down the line, OYO introduced the franchisee model wherein the company takes over the entire inventory, allowing it a free hand in terms of pricing, in terms of listing, management, etc., which obviously hotel owners were not very happy with as it made their revenues and cash flows a lot more volatile. The second big issue OYO faced was with its minimum guarantee promise, which honestly has never worked ever. And the team at OYO should have learned from what happened with Reebok India a few years earlier, but because they didn't, OYO met the same fate as many others with an overestimation of demand, poor cash flow management, and of course, massive losses, which culminated to a loss of a little over 13,000 crores in FY20. As OYO's property roster ballooned, a disproportionate number of quality control issues started to emerge, with many hotel partners and customers reporting inconsistent service, maintenance problems, and even misleading room advertising. In spite of many resets, the complaints continued to pile up, and by 2020, OYO's reputation was taking a massive hit. And the final nail in the coffin was, of course, COVID, and with no demand forthcoming, the company understandably had to take steps to stay alive, including laying off employees in India and abroad, shutting down properties, rejigging the business model, and a complete stop to growth. Things had gotten so bad by then that OYO had to pull out of an IPO it had filed in September of 2020 as the company grappled with heavy losses, multiple lawsuits, an investigation into fraud by the SEBI, and a very uncertain future. But having said this, uncertainty can be a good friend for the buyer of long-term values, and one platform that helps long-term investors capture this value is Incred Money. As one of India's top platforms for investing in unlisted shares, Incred Money gives you access to a variety of emerging companies in this high potential space. It has the trust and backing of the Incred Group, a diversified financial services conglomerate with interests spanning across asset management, lending, alternative investments, etc. You can start on Incred Money with a minimum investment amount of just 10,000 rupees, and in many cases, you can buy as little as one share. The platform charges no transaction fees. You'll find useful information here, including the key financials for every company. Track your orders with absolute ease on the platform itself. For any kind of support, connect with their customer service team on these numbers or via email. And as a special offer, Incred Money is offering my channel viewers a 0.5% discount on your first transaction, the link for which is attached in the video's description. There's a line in The Dark Knight, the movie, that goes,
"The night is darkest just before the dawn."
and the one good thing that came out of their troubles is that the team at OYO found some thinking time and a reason to recalibrate their strategy. So here's what they did starting from the year 2020. Firstly, OYO focused on their core markets like India, Southeast Asia, and parts of Europe as they scaled down in other countries like China and the US. In fact, from a high of 80 countries, OYO now has focused operations in around 35 countries, making it more controlled and manageable for them. Point two, the company aggressively got rid of non-performing properties, basically ones with low visitor turnout or poor customer experience, as it refocused its energies on sustainable and profitable growth. This image here perfectly showcases this drive, as OYO didn't flinch in shedding some 5,000 hotels in FY23, only to win back a superior set of properties the very next year. Next up are the costs, and the team at OYO left no stone unturned to drastically cut operational expenses, efforts which have started to show results in these past 3 years. In numbers, OYO's cost base as a percentage of revenue has improved from a high of 77% to around 30% now, yielding an EBITDA of 888 crores in FY24, giving the company its first profitable year on an after-tax basis. I think we're at point 4, and the new OYO is now focusing on making more money from its existing hotels. And to give you a number, OYO made 3.9 lakhs per hotel in FY23 as compared to 2.19 lakhs a year back, which is a jump of 78%. This aligns with their move away from the minimum guarantee program that's now in just 0.1% of storefronts, so almost nothing, as the company moved into a more viable revenue sharing model, which not only removes financial pressures on OYO but puts a higher emphasis on improving customer experience and using technology to cut costs. Okay, now that I have touched upon experience, OYO's mobile app and Trustpilot numbers are on the rise, with the company targeting a rating of 4.5 stars by the end of this financial year. And finally, there's debt management, and presently OYO has managed to reduce its debt significantly by prepaying approximately $195 million in loans that will save them nearly $27 million in annual interest expenses. This strategic deleveraging has reduced the company's debt to EBITDA ratio from 10x to a more manageable 3.3 times, positioning it for sustainable future growth and, if I may dare to say it, a possible IPO in the coming year or so. But IPO or not, OYO has learned its lesson the hard way, and it is my belief that OYO will be more careful, not careless, and more selective as it continues to innovate and expand selectively into newer markets and product lines. Actually, now that I think of it, OYO's journey is a lot like many of the companies I've covered in my newsletter, isn't it? I mean, look at some of the stories I've covered. Sami Hotels' remarkable turnaround post their IPO, BLS International's revenue surge following their acquisition in Turkey, Zaggle Prepaid's impressive growth and international ambitions, Sky Gold's continued rise fueled by increasing consumer demand, Garware High-Tech Films and its potential doubling of EPS over the next 2 years, and this latest one on Ugro Capital and its quest to become the go-to lender in the MSME space. The recent stock market fall has improved valuations in many of these counters, so if you haven't subscribed to my newsletter, then kindly do so now. Do go through my write-up on each stock and also tell your friends about it. Okay, now let's look at OYO's financials to see where we currently stand. Please recall the last two times OYO filed for an IPO. In 2021 and 23, it was besieged by some problem or the other, including volatile market conditions, a steep drop in valuations, massive losses on the operational side, high debt, SEBI asking for it to refile, lawsuits by industry associations, fraud allegations, etc. But that was then, and what we see now is a very different OYO, which is profitable on an after-tax basis, whose gross margins are improving, definitely improving, the debts are a lot lower, and the operating expenses are not as rampant as yesteryears, all indicating that OYO is now a tightly run ship. To understand the financials better, I went through OYO's FY24 financial report. The link is there in the description, or if you prefer an overview, then do check out the information section on Incred Money for a simple yet clear assessment of where the company stands. So everything here looks great, and at an EPS of 0.36 rupees and a share price of 54 rupees, this gives us a P ratio of 150. This might seem a bit expensive now, but remember the PAT number is as of March 2024, and if one instead factors OYO's projected PAT of 700 crores for FY25, it means this P ratio can potentially go down to 50 on a forward basis. A number like 50, even 60 doesn't look out of whack when I compare it with India's leading hotels like Oberoi, Indian Hotels, Lemon Tree, Sami Hotels, Chalet, etc., which are way above 60 in spite of not having the size or diversity that OYO has. Of course, this is just conjecture on my part, and a lot can change over time. OYO might raise more funds from private investors, operational issues might prop up affecting profitability, revenues might drop due to any reason, or OYO might just decide not to do an IPO. These are market risks that every investor has to live with, but what's equally important is for us to understand the market opportunities as well. And in the case of OYO, there are quite a few, including the fact that OYO has started expanding its product line as it now seeks to tap into the premium hospitality market through OYO Townhouse and OYO Homelex, and through brands like Palette and Sunday, which target a higher end customer base that values comfort and value. OYO is also leveraging its experience of managing properties by expanding into managed vacation homes, especially in high demand regions like Europe and Middle East, as it continues to add value accretive businesses like holiday parks and premium apartments to its roster. OYO even did some acquisitions in 2024 to support its growth ambitions, including G6 Hospitality that it bought from Blackstone for $525 million. This is a business that generates $1.7 billion in revenue, and OYO also acquired Check My Guest, which is a Paris-based premium rental homes company, and this was bought for some 230 crores. Another very interesting initiative, Okay, a quick background. A reason why OYO faced a number of difficulties in the past was because it was dealing with legacy hotel owners who weren't comfortable with technology and made the process very complex. OYO is now deliberately looking for young first generation hotel owners who it can train to run their hotels more smoothly. And for this, the company has launched a dedicated accelerator program and is already running some 1,000 hotels under this project. Only time will tell how effective these strategies and initiatives are for the company, but it's difficult for any of us to overlook that OYO's journey of highs and lows is also a story of resilience, adaptation, and learning. The company's emphasis on profitability over rapid growth shows that it has learned from its past mistakes, and as it navigates its path forward, everyone's watching to see whether OYO's comeback will solidify its place as a leader in global hospitality, or will it serve as a cautionary tale for startups chasing unicorn status too quickly? I sincerely hope you liked this business case study. It's the first on my channel and has been presented with an investing scenario in mind. I personally believe an IPO might still be a year and a half away. But if OYO continues on its path, it's no longer a question of if and only when that IPO will happen. If you're keen on catching the bus earlier, then do log on to Incred Money and do buy your unlisted shares from there. You can start from as low as 250 shares. There are no charges or brokerage. The prices on Incred Money are super competitive, and don't forget there's a limited period offer, a 0.5% discount on your first transaction when you purchase these shares using my link that's attached in the video's description. Once again, thank you for your time. Do like this video, do subscribe to my newsletter, and I'll see you very soon. Until then.